started. Thank you.
All right, we got a little after one here. This is Tom Hughes, the president of the Natural Hazard Mitigation Association. This is the third or fourth presentation in our series this year. Where this one right here will be on risk rating 2.0, a holistic view. We're going to be looking at it from a public, private, state, and local perspective. And our guest today will be Joe Rossi from the private sector, Tony Hawke from FEMA headquarters. We have Bill Bradfield, the state NFIP coordinator for the Commonwealth of Pennsylvania, and Josh Lippard, former floodplain manager for City of Pittsburgh and currently with the City of Philadelphia. Just a little bit about the Natural Hazard Mitigation Association. We were created in 2008 to bring together individuals, be it research or practitioners, looking at that we're interested in hazard mitigation and climate adaptation. We have been a FEMA cooperative technical partner since 2013. We look at an informed and effective grassroots approach to things. Definitely want community participation in all that we do. We look at innovative partnerships and collaborative solutions. Just a little bit about NHMA, what we're up to. We developed a strategic plan recently, and we just rolled that out, and we're due to update that again in the next couple of months. We look at ways to reduce the risk and consequences of natural hazards. And in that strategic plan, we're tightening it up. We also have an area identified with our Resilience Neighbors Network on working with local communities to that end. Grassroots, special emphasis on addressing the increasing risk to most vulnerable populations and communities. And the goal is to help communities assess and understand their natural hazard risk and how to drive down and manage risk with the support resources that we can provide with our hazard mitigation expertise. So we truly are, a leader in the mitigation sector, and are striving to do even better now. If you want to know more about our Natural Hazard Mitigation Association, there's the email that you can send something to us in an email, or you can go to our website listed there. So with that, I'm going to turn it over to the folks from FEMA headquarters. I guess, Tony, you're there? I don't know, can Tony?
Yes, I'm here.
You're on mute? Okay.
For some reason, my buttons weren't working too fast here.
And then I had to stop share, I think, right?
Yeah, and then Tracy will share.
Tracy will share then. Okay. Just a little bit about Tony. Mr. Hawke is the director for the transformation of the National Flood Insurance Program, or NFIP, of which risk rating 2.0 equity in action is a major component of the RR 2.0 equity in action. He streamlines and simplifies the delivery of the NFIP for stakeholders and policyholders. During his tenure at FEMA, Tony has led numerous transformation activities in various capacities, including the consolidation of the hazard mitigation grant programs guidance and review process, the streamlining of the individual assistance grant programs, and the establishment of the response recovery cadre management team. In his previous roles, he also served as the director for the product delivery division of federal insurance, which encompass NFIP claims processing and underwriting, industry management, and the NFIP direct contractor, as well as project officer and risk management, where he started his FEMA career. Floor is yours, Tony.
Okay, thank you, and good afternoon. It's a pleasure to be here. I wanted to thank everybody before we even started for all that you guys do. All you folks do. You do a lot of great efforts in helping our nation be more resilient, prepared, and all those types of things. And also want to thank Joe for all his efforts and support of what he does for FEMA, as well as just general industry. Hopefully everybody's been staying safe and healthy. Be nice to do these things in person, but we can't do that at this time. And I wanted to thank you again for your interest in learning more about the National Flood Insurance Program's new pricing methodology, what we refer to as risk rating 2.0, equity in action. As you may know, the new methodology is being introduced at a time when we're experiencing more frequent and intense weather events. And as flooding, and flooding remains the #1 natural disaster in our country. Even so, we believe that insurance coupled with mitigation is the first line of defense against the peril of flooding, and in most cases leads to a quicker and more predictable recovery for survivors. With increased technological and mapping capabilities, what we'll call Risk Rating 2.0 Equity in Action will communicate a property's full flood risk rate and equip property owners with the information they need to make informed decision about these mitigation actions. And I'm going to emphasize again, it's equip property owners with their full risk rate. They, existing policyholders may not be at that rate, and I'll talk a little bit about that later. Some are going to go down, some go up, but I'll talk about that more. The legacy methodology, as you're well aware, has not changed in over 40 years, making it ill-suited to withstand these extreme flooding events brought on by climate change that I just referenced earlier. And in addition, the new rating methodology has exposed inequalities in pricing, and we can't ignore our policyholders who have been unjustly subsidizing other policyholders. And that is policyholders with lower value homes are paying more than they should, and policyholders with higher value homes are paying less than they should. So understand that the lower value properties have some of the highest rates in the NFIP today under that legacy system. So Equity in Action corrects this injustice. And then under Risk Rating 2.0, they will see a decrease in their cost of insurance. And I'll do a deeper dive, as I said earlier, into these areas as I quickly move through the presentation that I have lined up for you today. So next slide, Tracy. So now I'd just like to provide some foundational context about the new approach and what it will provide equitable rates for each property's unique flood risk. And as I do, please keep in mind that under the legacy system or the old system, all policyholders have seen an average increase of $8 a month over the past number of years and would continue to see increases year after year if we just left things as they are. Under Risk Rating 2.0, and for the first time in the history of the program, actually, we are preparing to deliver premium rate decreases at the time a policy renews. And we're actually doing that right now. We started that on October 1st. The new system is out there, it's working. Almost 6 million transactions have been processed in that system. In addition, there's additional policies, 20-some thousand additional policies have been also been purchased. And there's a lot of folks that are opting in for those decreases. So the system is working, it's running and going forward. So these decreases I'm talking about will occur for about a quarter of the NFIP book of business, a little over 1 million policyholders. Now, as some premiums decrease, as I mentioned, there will also be comparable premium increases for other policyholders. And we're mindful about the concerns over increases, and we're upholding the statutory requirements that limit those annual premium increases. So no rates can climb by more than 18%. So right now, Risk Rating 2.0 is being used. Next slide, please, sorry. Now I'll explain the phased approach announced last March. And it's the best path forward for implementing this new pricing plan. So back on October 1st, we implemented Risk Rating 2.0 for all new business, as well as existing NFIP policyholders would be able to take advantage of the decreases at their time the policy renewed between October 1st and April 1st. Then in April of 2022, all the remaining policies will be written under the new pricing plan at their time of renewal, allowing these policyholders extra time to prepare. So starting in April 1st and going the whole way through March of 2023, folks will be renewed into the new pricing methodology. Next slide, please. So as the name implies, Risk Rating 2.0 Equity in Action is rooted in fairness as it addresses an inequality in the program that has inadvertently developed over time and must be corrected. And as I stated earlier, policyholders with lower value homes are paying more than they should, and policyholders with higher value homes are paying less than they should. So this new pricing plan enables FEMA to set rates that are fair for policyholders and ensures that both rate increases and decreases are equitable. In fact, we've learned that 2/3 of the older pre-firm homes that have some of the highest rates in the NFIP will see immediate premium decreases in the cost of their insurance at the time of renewal into risk rating 2.0. So simply stated, it's the right thing to do. So next slide. And to appreciate what risk rating 2.0 equity in action means and how it's an improvement over the legacy rating methodology, it's useful to consider where we're headed in comparison to where we are. So since the 1970s, rates have been primarily based on rather static measurements, emphasizing a property's elevation within a zone on a flood insurance rate map. This approach does not incorporate as many new variables as the new methodology. And as such, risk rating 2.0 equity in action is not just a minor improvement, but it's a transformational leap forward for the rating, insurance rating of the NFIP. So FEMA now has the capability and tools to address the rating disparities by incorporating more flood risk variables like multiple flood frequencies, not just a 1% annual chance event, multiple flood types from river overflow, storm surge, coastal erosion, heavy rainfall, and distance to a water source, along with a property's characteristics such as elevation and the cost to rebuild. And that one's important, the cost to rebuild. So since the new plan takes into consideration the cost to rebuild, FEMA will equitably issue premiums across all policyholders based on that unique flood risk characteristics of that property. So this has been an industry standard for years, and the NFIP is now finally adopting it. So risk rating 2.0 builds on years of investment in flood hazard information by incorporating private sector data sets, catastrophe models, and evolving actuarial science. This includes using existing FEMA mapping data and NFIP policy and claims data, along with other federal government data from the USGS, NOAA, and the US Army Corps of Engineers. In addition, third-party commercially available data for structural and replacement costs, along with the catastrophe models, are all incorporated. So you can see that this approach is clearly a significant improvement over the previous, and it allows us to set actuarially sound rates and communicate the flood risk more comprehensively than ever before. Next slide, please. So I'm going to dip a little bit in and probably overlap a tiny bit with Joe, so I'll apologize, Joe. So what's not changing? So risk rating 2.0 equity in action is transformational, but it's not changing every aspect of the National Flood Insurance Program. So we're upholding the statutory requirements by limiting the annual premium increases, like I mentioned previously. And those existing statutory limits require most rates not climb by more than 18% per year. Also, the use of flood insurance rate maps for mandatory purchase and for floodplain management continues. And we will continue to offer premium discounts for pre-firm subsidized and newly mapped properties. And policyholders will still be able to transfer their discount to a new owner by assigning their policy when the property ownership changes. And discounts for policyholders in communities who participate in the community rating system will continue. However, since risk rating 2.0 does not use flood zones to determine the flood risk, the discount will be uniformly applied to policies throughout the participating community, regardless of whether that structure is inside or outside the special flood hazard area. So, next slide, please. So as I said earlier, I'll take a little bit of a deep dive into the legacy rating system versus risk rating 2.0. And as you can see from the bar graphs below, how they compare. So under risk rating 2.0, 23% of policyholders nationwide will see monthly premium decreases, whereas under the legacy system, none did. This simply didn't happen. The rates went up year after year. This should not be overlooked because it speaks to one of the tenets of equity in action, which is to reflect a property's unique flood risk accurately and fairly, and to price it accordingly. So before I move on to the next two categories of policyholders in the blue buckets, you'll recall that I shared under the current pricing scheme, all policyholders have been seeing on average an annual increase of $8 per month. So under the new pricing methodology, 66% of the policyholders will see a $0 to $10 per month increase in their premiums. And the impact on these policyholders is relatively neutral in year one because it's very similar to what they would have had under the legacy system if we didn't implement risk rating 2.0. Another 7% of these policyholders will see about a $10 to $20 a month increase, which is somewhat more than what they're paying now. And then finally, 4% of the NFIP policyholders will see a $20 or more increase in their monthly premiums. These policies cover, however, high value homes in high risk areas. And currently lower value homes subsidize these properties and are paying way more than they should. So let me be clear, under both the legacy rating system and under risk rating 2.0, 4% of the policyholders see premium increases of more than $20 a month. We're right on the cusp about to issue the comparison information at the state level for folks. It will show the old system and the new system side by side. It will incorporate the replacement cost value along with that information. And what you'll be able to see is what we're talking about, equity. So under the old system, when you went through that 4% and into the highest rated structures, the replacement cost value, the higher the rate went, the lower the replacement cost value was, and it didn't make sense. Under the new system, that's flipped on its head, basically. There are far less in that category, but the ones paying the highest value have the structures that cost the most, over $1 million, $2 million. Those are the folks paying the highest. So that's the inequity that we're taking care of. Next slide, please. So let's take a closer look by comparing at the comparison by zooming in on that 4% that I was talking about. So we can see the number of policies increasing by more than $100 a month. And you see the legacy system here, or the old system, and risk rating 2.0. So under that legacy rating system, over 45,000 single family policyholders have been seeing premium increases over $100 a month for many years. However, these single family homeowners in this group have a replacement cost value of $399,000. So under risk rating 2.0, only 3,246, over 40,000 fewer single family policy holders will see premium increases of more than $100 a month. However, and like I mentioned just before, the single family homeowners in this group have an average replacement cost value of $1,064,000. So you can see that what I was talking about, the flip over who is actually going to be paying. And I think these numbers speak for themselves. And please recall, without risk rating 2.0, all premiums would continue to increase for all properties. Instead, the new pricing methodology stops that trend of continually increasing premiums on everyone. Next slide, please. So even policyholders paying the most today will see quite significant decreases when they transition to the new pricing plan. So broadly, over 1 million policyholders will see decreases. This includes roughly 600,000 single-family homes. Currently, 3,000 single-family policyholders pay premiums above $12,000 a year, and in some cases up to $45,000 a year. It may surprise you, as it did me, to learn that these policies are located all across the nation and not just in the Gulf Coast. And again, under that legacy rating system, these premiums would continue to increase every year. The new plan, however, risk rating 2.0, has placed an upward bound on the limits the cost on the highest end of the spectrum. So this means that no single family home policies transitioning into this new methodology, including those 3,000, will see a premium of more than $12,125 in equity in action. And I want to pause on this slide just for a minute, because this is a significant change that I think sometimes gets overlooked or is underappreciated in these presentations that we give. So next slide, please. So as you can imagine, designing this new rating methodology takes an enormous amount of resources, time, people, and technology. It didn't happen overnight. We relied on state-of-the-art technology and best available data to create this modern-day rating system that expands on years of scientific developments, actuarial data, and environmental analysis. So it's a multi-model approach that was determined to determine the flood risk using a suite of models, much in the same way that NOAA does or uses with several models to determine those potential hurricane tracks and magnitudes. So what we did, we first licensed 3 sets of commercial catastrophe models: Air Worldwide, Cat Risk, and CoreLogic. And then in addition to these commercial models, FEMA developed 2 additional models based on government data. And Equity in Action is designed, I want to point out, to adapt to climate change by using a full range of flood risk across a suite of catastrophe models. However, because rates are based on the expected claims during the 1-year policy period, they should reflect only today's risk. And the actuarial rates do not pre-fund for changes in risk beyond the policy period. So future rates will be updated to reflect any changes in the risk as a result of climate change. And therefore, Risk Rating 2.0 already considers the possibility of events like Ida that recently came through this year. So its occurrence does not surprise us. And most importantly, it does not cause shock to the rates. Next slide, please. So stakeholders weighing in on the impact of Risk Rating 2.0 and what it will have on the community and policyholders. Just to note a few, the National Association of Realtors has weighed in and endorsed it. Pew Charitable Trust has also endorsed the Risk Rating 2.0 Equity in Action. In addition, back about a month ago, 16 organizations who actively monitor, advise, and yes, who have criticized the National Flood Insurance Program from time to time, from across the broad spectrum of interested parties, sent a joint letter to Congress strongly endorsing Risk Rating 2.0. So just to let you know, a lot of organizations have supported it. There still is, and next slide, please. And the following slide. So affordability. So let's turn our attention a little bit to affordability, which is currently an issue and will continue to be a concern with the implementation of the new pricing methodology. So in other words, Risk Rating 2.0 doesn't create an affordability challenge. It's one that's existed for years. So hopefully the FY22 President's budget included a legislative proposal that would establish a means tested assistance program for 1 to 4 family primary residences, and which the NFIP has included in our multi-year reauthorization outline. If passed by Congress, this target assistance program would serve to offer low to moderate income current and prospective NFIP policyholders with a graduated risk premium discount benefit. It's important to note, though, that FEMA would implement the program to all eligible policyholders, but they would also see their full risk price as well as their means tested assistance. So they have an understanding of that full risk, which is imperative to building a more resilient nation against the perils of flooding. So, and we look forward to collaborating with the administration and Congress on ways to reducing the barriers to purchasing flood insurance, and as well as pursuing mitigation options. Last slide, or next slide, please. So if you haven't already, we encourage folks to look at the Equity in Action website at FEMA.gov/NFIP transformation. There's all kinds of information on there. There's fact sheets, there's national analysis, state profiles, mines down to county and zip code level data, methodology source data, all kinds of good things on there. In addition, like I said, in the coming weeks, we'll be adding the comparison information to this at all 3 of those levels, state, county, and zip code, so folks can really see how it actually pans out for them. So in closing, let me say that Equity in Action will deliver a more equitable and risk-informed NFIP. And what we've developed is a foundational component in conjunction with other efforts that will transform the program and advance our movement to reduce disaster suffering following the devastating impacts of flooding. So, and I want to thank you and I appreciate your time today, and I'm going to hand it back to you, Tom.
Tony, we had 2 questions come in.
Sure.
I think it'd be before we move on to Joe's presentation. Does the 23% decrease account for the CRS community discounts?
What do you mean for there?
It says does a 23% decrease account for the CRS community discount? So I guess, are they included, the community discount rates?
I'm going to say up front, no. What we're seeing in that national analysis that I'm talking about, that is what the rate would be. So that doesn't have any mitigation credits, any discounts in it, those types of things, as well as, you know, they are basically estimates, because like if Joe was Joe Rossi was one of my clients and I was an agent, I would work with Joe as well as say, Joe, do you want to change your deductible? Do you want to change your coverage? Have you added, you know, some mitigation? Have you elevated your mechanicals? Have you added vents? And all those things would start to come off and refine that quote. So not all those discounts and things are included, subsidies are included in those full risk rates that folks are getting from agents when they call in now. And that's what our tables are based on too. So.
Alrighty. And from Jennifer, second question. You just mentioned the state level data is coming. Will that incorporate full risk rates or just the year one differences?
So what you'll see is that data that's already out there reflects year one. You can see that because that's the decreases only occur in year one, or mainly the main set of decreases occur in year one. The full risk rate is something they would get from an agent. If you know what I mean, they would have to get that from an agent and work with them on that. The other information I'm talking about that's coming out would be more reflective of what's going to happen as a comparison between the two. So it'll be the next year. So it's hard to actually predict what goes on in years 2, 3, 4, and 5. We're predicting that in that full risk rate that they get, but the factors as we refresh could change that. So, you know, a structure could come in and have 2 claims added to it in 1 year. That full risk rate that we're giving them could change in year 2. Or it could come into, their community may come into the CRS program, and their community may be one that gets 35% discount. You know, all those things change. So relatively speaking, the new stuff coming out comparing the legacy system to the new methodology will be for year 1. Now we are working on additional information. I don't want to get myself in trouble to follow that up that would show you the full risk associated, or try to depict, because they're not quite apples to apples, the old system to the new system for rating. So it's hard to do some of that, but to try to show individuals at the state level what the averages would be, and then the difference in those. So it's actually shocking to some folks when you can put it in that perspective. I'll say something online. Hopefully I'm not going to get myself in trouble for this one either, but the state of Florida may shock you, has under the legacy system, has the lowest average rate in the nation. So if I told you that, you would probably be scratching your head right now, right? That doesn't make a lot of sense. But under the new system, it wouldn't, because we take into effect, you know, the distance to the coast, a lot more elevation data, a lot more consideration of storm surge, all those things come into play. So that's one of those imbalances I'm talking about, but we're working on showing that information at the state level. And there's a lot of states that go down. Their average goes down, and not by $5 and $10 either. So, you know, you folks included on here, you know, folks from, I know there's Pennsylvania folks on here, have complained that you subsidize some of those folks. Well, we're admitting that that was true under the legacy system, and that's something we're fixing too. So there's cross subsidization going on between lower value and higher value, between different geographic areas of the country, and so forth and so on. So this will fix that. So I gave more of the answer than you probably wanted.
Roger that. So, Joe, you're there? Okay, we're good. All right. Yes. Joe's going to be taking a more of a deeper dive here on a number of slides here, and I just want Joe Rossi is the CEO and the president of Joe Flood Insurance Brokerage, a flood insurance wholesaler based in Massachusetts. Joe graduated from Wentworth Institute of Technology with a bachelor's degree in architecture. Joe began in the field by chairing the town of Marshfield Seawall Committee in 2010. He now participates on several committees which run the gamut for local to national organizations, each of which allow him to offer unique and specialized assistance to the community and to flood stakeholders. Warm welcome here for Joe Rossi. All yours, Joe.
All right, great. Thank you. And I want to thank Tony, who just did a phenomenal job. You know, it's funny. I remember when Tony would do these presentations with, not a lot of detailed information years ago. And now we're here and we've got all the detailed information. And really to see this evolution on where FEMA has been and where it's going is phenomenal. So Tony, thank you so much for that detailed information and the statistical information that FEMA has come out with, which I know by talking to community officials is extremely helpful. And now it's being digitized and utilized by many. So again, thank you. I want to start today by kind of giving an overview of the reason that I've called my presentation a holistic approach. This word gets thrown around a lot when we talk about like holistic approach to natural disaster recovery and holistic approach to other things. Well, really what Risk Rating 2.0 is doing is taking that holistic approach, that top to bottom approach to not only insurance rating, but what will eventually change our vernacular in the entire industry. In understanding and working with FEMA on several of the national boards I sit on to understand its implementation and work with FEMA on its implementation, I can tell you this firsthand, that I think once, every change has obviously kinks that eventually get worked out. And so Risk Rating 2.0, along with any major program that's being implemented, obviously has concerns from stakeholders that we will work out over time. But this is a giant leap forward, and I cannot say that enough. So again, you heard my background. Just to give you a little bit more detail, just from my perspective, I look at things from not only the insurance side, but the floodplain management side. And of course, I've been involved with NHMA for years on their RNN community network. So I want to thank NHMA also for including me in that over the years. And so, Tony basically gave a really, really good introduction to 2.0. So I'm not going to equity in action. So I'm not going to really focus on that part of things. I do want to get more into the details of some of the things that are changing. But again, what FEMA is doing is they're moving from this binary, zone-based rating to a graduated system that really is making things, as Tony explains, clearer, fairer, and to meet current industry standards. Really, the easiest way to put it is it's a total redesign of the legacy rating methodologies, which are no longer or which have now, as of October 1st, and we'll touch on it, have come and gone. So but I want to take some time and explain some of the bigger questions that I'm seeing out there, and try to give a comparison on what was legacy and what is changing. And when we say legacy, we're referring to Risk Rating 1.0 or the NFIP prior to October 1st of this year. So the first thing that we get a lot of questions on is the preferred risk policy. Under the legacy system, a set number or coverage amounts were sold in what was called the preferred risk policy, which was a low-cost policy for those buildings in low-risk zones that met a definition of, low or no losses, and there were several other conditions where a structure could receive a preferred risk policy. And they had a combined building and contents limits, and they were sold for relatively inexpensive amounts of money with low deductibles. Several months ago, with the implementation of Risk Rating 2.0, preferred risk policies are no longer sold. And under Risk Rating 2.0, however, rates for those buildings may actually be lower than the prior preferred risk policies were, but they also may be higher for the same coverage limits with the same deductibles. So again, as Tony mentioned, there's no longer this broad stroke of premium. It's going to be based on that building's individual risk. So therefore, the preferred risk policy just didn't make sense anymore. And that individualized risk is now determined on all policies. I will note, though, and I know the term we've used grandfathered for so long. I have used it here, but really what's happening is those policies that are PRPs today are transitioning into Risk Rating 2.0 and not just disappearing. And what's happening is they are on a glide path if they're going up. But if they're going down in cost, again, you can go to Risk Rating 2.0 immediately to see that benefit. And also under risk rating 2.0, grace periods are changing. In the legacy system, if a policy lapsed, an insured had 30 days to pay and retain coverage, but a total of 90 days to retain grandfathering. So there may have been a actual lapse in coverage, but you could actually retain that grandfathering after that time. But under risk rating 2.0, everything is under 30 days. So the reason that this is important is really the summary of this slide is don't allow your current flood insurance policy to lapse, especially if you are on a glide path going into risk rating 2.0, because that could cause some significant issues for insured. So it's all under the expiration date plus 29 days for a total of 30 days is the current or the new grace period. And elevation certificates, again, this is another area that has changed, and I think we'll find it helpful. This change will be helpful for many, where in the legacy system, elevation certificates were required essentially for most new construction in high-risk flood zones, and elevation certificates gave beneficial ratings for those structures for the most part, and elevation certificates, the information that we used on them was things like base flood elevation, the height of the lowest floor, the community map information, all these things that were on the elevation certificate. But now under risk rating 2.0, FEMA has a methodology to determine the first floor height by using internal sets of commercially available data. As Tony mentioned, that is something FEMA uses now, which was not used in risk rating 1.0 or the legacy system, which was commercially available data. So an elevation certificate may be used as an option to get a more precise first floor height, but this is optional. So what's really great is, this is actually later we talk about messaging. I think a lot of risk rating 2.0 and where we are right now is developing messaging around to give to, stakeholders. And one of the great messages around 2.0 is, look, you don't have to get an elevation certificate to get your rate, but it's a great tool to potentially look at lowering the premium because, again, if the elevation certificate helps the rate, then it's used and the rate, the premium for that building goes down. The elevation certificate will still be used, of course, for floodplain management requirements. So I think in my mind, in learning about 2.0 over the years, it takes some time to separate now insurance from the mapping and floodplain management. They're still related, obviously, but there's some major elements that have sort of been disconnected from that. So mapping and elevation certificates will all still be a floodplain management requirement going forward. CRS. CRS discounts, obviously the community rating system, are for communities that participate and give premium discounts to those buildings that qualify. And there are, of course, conditions, but for the most part, all structures in A and V zones and then standard rated X receive that CRS discount. But under risk rating 2.0, for all intents and purposes, that CRS discount is being extended to all federally purchased flood insurance in the entire community. So again, there are some conditions that apply, but for the most part, that expansion of the CRS discount will be very helpful for communities going forward. And also mitigation. In the legacy system, there was no significant benefit to elevating mechanical equipment. It was actually used more as a penalty than a discount. Flood vents put into foundations can make a significant impact on rating in the legacy system. Elevation of mechanical to the next higher floor does give, and I say small, it's actually it can be a significant discount in relation to the premium. And while flood vent reduction in premium discounts has been significantly diminished in relation to what it was in the legacy system, in some cases, it still gives a significant discount when you look at what they're getting a discount for. So don't let this slide be deceiving, because these mitigation discounts are still a critical message to deliver to insureds. Venting, elevation of utilities, which was not a creditable mitigation discount before. These are things that we encourage. You can see a slide or a little picture at the bottom of my slide giving an example that if the mechanical is raised to the next highest floor, there is a discount given. So this is a really useful tool in messaging, and we'll talk about that closer to the end. And then rate tables. This is actually something that I think is is going to be a little getting used to, but I think it's beneficial for insureds because rather than having rate tables where anyone can open up an NFIP manual to see the rating tables in the back, under risk rating 2.0, now the rater has to give the engine, the online rater has to give that individualized rate. But again, that is just moving towards that risk-based actuarial rate and premium has to be done on a per building basis and only available to agents, and write your owns are the ones accessing this rater. So the message I would give to communities on this is just make sure that you're teaming up with knowledgeable agents to help you through the rating process under risk rating 2.0. Tony, I think mentioned some of this already. We're actually moving through the policy transition process. We checked off August 1st. We checked off September 1st. We're now after October 1st, where we have an option now for policies to either stay with risk rating 2 or stay with their legacy rate or move into risk rating 2.0 at their renewal if it happens between now and March 31st. On April 1st, all existing policies with renewal dates on or after that day will be renewed under risk rating 2.0. So we are moving right along here. Risk rating 2.0 is here, and it's it's working. And actually, we're going to take example in a minute of how it's working in the messaging around it. So things that will not change. Again, Tony mentioned some of these before, like existing legislative issues, affordability frameworks, forgiveness of debt, the annual rate increases, the amount of insurance available, congressional issue, mandatory purchase, floodplain management standards, policy forms for now, CRS program and credits. What that means is that at the moment, the manual itself is not changing, even though we mentioned earlier that the credits themselves and how they're implemented may be changing a bit. The right to own commissions, the LOMA program and process, increased cost of compliance amounts, and the assignment of a flood policy, for the most part, is all staying the same. So the assignment of a flood policy is changing a little bit, but the traditional way of assigning a flood policy is still beneficial and is still a process that agents can move through. So again, these are things that are not changing. And some rating examples. So, I like to use these examples to highlight the individualized risk and the things that are impacting that risk. And so, here we have an older building that's elevated on piles. And this is to give you an example of what mitigation and elevation can do to a rate along with foundation types. So you'll see that this building's around 3,700 square feet. Its value, again, Tony mentioned replacement cost plays a major role, $615,000 in replacement costs, and they have the 250 building with a $10,000 deductible. You can see here, the risk rating 1.0 rate was $9,100. And you can see the risk rating 2.0 rate without the elevation certificate is $1,728. So, to me, what this says is elevation and mitigation of structures like this is extremely beneficial and recognized under risk rating 2.0. You can see that with the elevation certificate, of course, there's a further benefit, and you'll see the two numbers at the bottom, FEMA determined first floor and the elevation certificate first floor is quite different, but the impact on premium wouldn't reflect such a wide variation, which again, messages to me anyways, that there is a significant discount for the elevation of that building and its location. So this is an example, and the fact that it's on post piers and piles. So and then here's an example where a building is new construction. It's in an AE zone. I think the other one was VE. Yes, it's around 1,000 square feet. $305,000 in replacement cost with $250,000 in building and $10,000 deductible. Now here you're seeing quite a significant increase from $881 to $2,793. Of course, the elevation certificate brings that premium down further. And if there were no vents, the discount there is about $100 with or without vents. But I think what's important in the messaging around this to me is that the risk for this structure is clearly higher than it was ever communicated to the insured before, because you're going from 881 to 2793. Now, again, this is a structure that would get on the glide path and go up at 18% annual increases each year. And you'll see the elevation of the building FEMA determines it at 4.5 feet. It's actually pretty close. The first floor is actually 5.3 feet. And that is the difference. I should have mentioned that number is the difference between the lowest grade and the first floor. We're no longer comparing to base flood elevations. So the difference between the first floor and the lowest grade, FEMA determines 4.5. It's actually 5.3. So again, that is telling me, like I mentioned before, that this building's foundation, elevation, and location makes it more risky than what FEMA had determined it to ever be in the legacy system. Now I want to talk about the location of a building having a significant impact on, or a impact on rates. You know, I think Tony mentioned earlier that replacement cost, distance to water, location of the building, all have a big impact. This is a really good example of how a building in the same zone, in the same general area, would in the legacy system be rated similarly, but in risk rating 2.0, the rates vary dramatically. These are two distinct flood risks in its same zone and same general data construction, same general building type, you'll see as we go through this, with two very different rates. You'll see they're only several houses away from each other. And in the bigger picture, you'll see that their flood risk, though, varies a bit from its location. House 2 is more on kind of the end of a peninsula. It faces more the ocean, which is up in the top right-hand corner, where the building at the bottom is further in on the peninsula, has more of a marsh exposure, and is not necessarily exposed as much as House 2. So let's take a look at each building here. Okay, sorry, had a hang up there. You'll see House 1 is post-firm, so it's new construction. AE zone around 4,000 square feet, $1 million replacement cost, $250,000 in building and $10,000 deductible. You'll see that the risk rating 1.0 rate is $3,400. Again, remember, House 1 is the one further in. With no EC, it's going to $1,239. And with a 2.0 with EC is 1115. So there's a recognition that this building is certainly a little bit less risky than maybe FEMA had determined before. FEMA difference in first floor is 0.3, but the EC shows that it's 2. So that's why the premium is going down further, because that first floor is actually higher than what FEMA has determined. Here's building 2. You'll see it's further out on that peninsula. It's post-firm. A replacement cost varies by about $200,000 over the prior building at $800,000. It's a little bit of a smaller building with 2,000 square feet. $250,000 in building in $10,000 deductible, so the same coverage. Risk rating 1.0 was $550, but risk rating 2.0 with no elevation certificate is $2,721, and with an elevation certificate is $1,719. Again, a recognition that just down the road, the risk has increased for this building, and FEMA determines the first floor at 0.3 when it's actually 4. So this building's higher up, but its geographic location, for the most part, is dictating its premium increase. And we've got real world examples to show, because this is a flood of record showing House 1 protected by its further inland exposure. You'll see the water in the picture. That's further out in the backyard. There's actually, and this is a real flood, same flood. In fact, these two photos were taken about 5 minutes apart. House 2, you'll see, is the house on the right there, is not only out on that peninsula further, but there's water underneath it. There is literally water under the house, and yes, it's elevated, but the building is clearly riskier, and there are real world examples here to show that. So what the rating is showing and what the actual flood is showing is there is a true flood risk difference between the two structures. So I want to conclude my presentation today by opening up discussion to the panel here on messaging. The discussing an increase or decrease in rates with insureds. So the message that I would say is a structure may be more or less risky, and this is the first time the insured is ever being told. So I'd invite the panel between Tom and Josh and others to kind of talk through some of this messaging if they'd like, as I go through them. I'm going to go through each one and then we'll back up. This next discussion is mitigation options with the insured. Well, the messaging is for structure seeing increase in premium, elevation certificates alone may actually help pricing right there, as we've seen. Elevating utilities is now a risk in premium reduction activity under equity in action, and adding flood vents to enclosures does offer a premium discount, albeit maybe not nearly as significant as before. Again, but it is a reduction activity. Floodplain managers, though, now have more fuel to advocate for home elevation, which we saw in one of the first examples. Additionally, there's an opportunity for floodplain managers and others to discuss private flood insurance options, which may offer premium relief. And the last discussion point is how to discuss risk requirement for flood insurance with insured. So that requirement to carry flood insurance versus its risk. The message is clearly that a lender requirement for flood insurance no longer directly correlates to the cost of flood insurance. Same with LOMAs, right? So if you're no longer required to carry flood insurance, that risk really hasn't changed. The drop at the line premium pricing is gone, which causes some premiums to increase and decrease. It also communicates true flood risk. So with that, I'll open up the panel. It's like, so I guess what I'll do is I'll kind of open it up to start having whoever wants to speak on these, how do you as a community official see this change, and how do you plan on having some of these discussions, or have you already had them with your constituents?
Yeah, hi, everyone. My name is Bill Bradfield. I'm the state NFIP coordinator here in the Commonwealth of Pennsylvania. Really good information. I think one of the challenges we've had with the risk rating 2.0 is that it's a change in a FEMA program, and we don't have the insurance. We don't have access to the engine. So this is really great information. I appreciate Joe kind of doing that deeper dive, because this is where we'd like to go and see how is this going to work out, over the next couple months, year or so as this transition happens. But this is a big one. We always talk about after a disaster, the people that get back on their feet the quickest are the ones that have the insurance. And I think that this program helps us kind of reiterate that we can actually tie the insurance to the risk and help communicate that it's important to have this there as we continue to go through. So I don't want to take up too much time on this. I want to make sure that everybody has a chance to speak, because I know we're kind of up against it, but I'm happy to talk about it. Josh, I'll let you kind of give your perspective too.
Yeah, thanks, Bill. Thanks, Joe. Yeah, I would say specifically in Pennsylvania, we deal a lot with row homes and brick construction with basements. I too would like to understand more about how basements play into some of these examples, as the examples given didn't really show basement spaces. But we are constantly having conversations. After Hurricane Ida hit Philadelphia, we had hundreds of homes who lost their hot water tank, their furnaces, their appliances in basement spaces. And we were messaging to them to build back better by elevating those up on platforms or to the next highest floor. So this will be extremely important in terms of our messaging moving forward. Thank you.
I do want to acknowledge too, I think there's a nice comment in the question session about hopefully making this easier for floodplain administrators, that you don't have to be an expert in insurance, that this program will empower the agent when they go in to actually work with them to be able to get a policy and a rating back relatively quickly. But you can just kind of focus on a couple key things to share as a floodplain manager with a resident or a business owner or someone who has a structure, and not be leaned on as also being an insurance specialist, which I'm sure happens a lot.
Which is why I mentioned that communities should be looking to further their partnerships with insurance specialists that are experts here, along with FEMA insurance specialists. But that's a CRS requirement, wink, wink to CRS communities, to encourage, their agents to participate in the community outreach on flood insurance. So, we may be seeing here in the future as CRS evolves to accommodate risk rating 2.0, more emphasis in those areas.
And Joe, this is Tony. What we focus on now is first floor height. So it's not the crawl space anymore. It's not the basement. It's that first floor height, which is, based on the ground elevation. So the basement could be your first floor. It could be a finished basement, or it could, it depends how you do that. So, but it's your first floor height, which is important. So not your crawl space elevation anymore and those types of things.
Yeah. Great. And I know we are getting up against it here. So thank you, Tony. I want to make sure I throw it back to anyone else that wants to answer questions or make comments. And I appreciate having been here today to discuss this.
I think we have a couple more minutes here, showing 3 minutes exactly. So I just I wanted to bring up, I think there was a question that came in the chat. I want to make sure that was answered. I think this one, will the elevation certificate and floodproofing certificate continue to be used?
Yeah, yes. Okay, I thought it was muted. Yeah. Yes, it will still be used. As I mentioned before, it will still be used not only for floodplain management purposes, but also for flood insurance, for that optional place to put in elevation certificate information. In terms of the floodproofing certificate, Tony, you may be able to answer that better than me. I've only used a handful of them and not any since October 1st.
Yeah, so I'd have to follow up on the floodproofing. For the elevation certificate, I did want to state though, if someone gave us an elevation certificate and it resulted in a worse scenario for them, we would not penalize and use that worst scenario.
Yeah.
We would use the FEMA scenario that would give them the better rate. So there's also a whole nother play in there too, there's 3 sources of data for elevation: USGS 10-meter DEMs, the elevation certificate, or what we call FEMA data at times, and CoreLogic. So it should be the best rate out of those 3 possible scenarios for that actual policyholder. So we're getting away from punitive and getting more flexible. So
I don't see any more questions in the chat here. I want to thank all the presenters today. A lot of information that was transferred over the 60 minutes here. I'm looking forward to the rollout here, continued rollout of risk rating 2.0. With that too, I'd also want to thank you for attending this session, and please, we need your feedback. There is a in the chat. There's a link for a survey to be filled out. It would take a couple minutes to do that. And if you have any ideas, shoot us an email on future offerings that you'd like to see from NHMA. And as always, if you're not a member, join us. We got plenty of work to do. So with that, you all have a nice day, and I appreciate the time you spent with us.